When we think about 2018, the first thing that comes to mind is the return of the business cycle. Essentially, this means that we're getting back to the traditional drivers that we'd expect to push our economy and our markets forward. We are still solidly in the second half of this expansion, and that's still very important and provides context to help inform our forecast for the year. We're getting back to the traditional roots that propel that cycle. I like to think about it like a sequel to your favorite movie. And what's great about a sequel is that we know what to expect. The plot is familiar, but there's always some twists. So what are the new storylines for this expansion? A big theme in 2018 is a coordinated fiscal response, including actions like government spending and tax cuts to provide added support for businesses. And let's face it, with better business fundamentals, things like revenue, earnings, and future growth prospects, this could spur further growth in the economy and the stock market.
The return of the business cycle will be most evident in the U.S. as fiscal policy becomes increasingly supportive of capital expenditures and business investment. With the transition from monetary to fiscal leadership, companies will be incentivized to invest in their future growth rather than simply buying back shares or paying dividends. This favors active strategies where investors can better identify companies willing to take economic risks and invest in their future growth.
These two key elements, fiscal support and strong business fundamentals, have been largely missing from this expansion storyline. To recover from the financial crisis, central banks around the world had to act fast. They enacted extraordinary levels of monetary support. The low interest rates that were supposed to encourage businesses to invest in their growth actually had the opposite effect. Many companies were satisfied by maintaining their current market share instead of competing for more. However, the broad stock market kept going up. That often led to interest rates dropping lower and risk assets moving higher. Now that's all slowly starting to change. The Federal Reserve has started raising rates, and businesses are increasing their focus on growth. So the characters are the same, but the dynamic is shifting. We're turning back to these market-driven forces, more business spending, earnings growth, and some risk-taking. Looking out to 2018, there may be some challenges along the way, but we think this new environment may bring some great opportunities for the global economy and for the markets. We expect the global economy to expand at a healthy rate of around 3.7% in 2018, thanks to a reboot in the policy, economic, and investment decisions across the developed and emerging markets. Here in the U.S., we project slightly slower, but still a respectable real GDP growth of around 2.5%, as fiscal support plays a larger role. We should see additional help from a pickup in business spending, while a strong labor market should continue to support consumer spending. In fact, business spending will be a key focus, as we expect this component of GDP to have the fastest growth trajectory in 2018.
Though economic growth is firming in Europe and Japan, they're both in earlier stages of recovery than in the U.S., with lower inflation readings resulting in plans for further central bank support. We believe the emerging economies have done an excellent job adjusting to China's moderation in growth, and we look for 2018 GDP growth of 4.8% in the developing world. Given the export-driven nature of these economies and the currency pairs relative to the U.S. dollar, it'll be important for monetary and fiscal policymakers to find the proper balance between both demand for exports and supply for investments into those countries. We're often asked about the length of the economic recovery and how it might end. Though no one knows for sure, we like to look at the fundamentals supporting growth. When considering 5 key areas, GDP, inflation, employment, interest rates, and corporate profits, we suspect the return of the business cycle can only help to elongate this expansion.
Given our outlook for the economy, Fed policy, and the potential for fiscal stimulus, we expect the fixed income market to be under pressure in the coming year. Moderate GDP growth and rising inflation may lead to gradually higher interest rates, which could limit bond returns. However, bonds remain an important element of a well-balanced portfolio. They can provide valuable protection should we experience any stock market pullbacks.
We look for the yield on the 10-year Treasury bond to trade within the range of 2.75% and 3.25% by the end of 2018. Though inflation is creeping toward the Fed's preferred target range, it remains well below levels historically considered threatening. While fiscal legislation may pose risks to the budget deficit and government debt, valuation will likely remain attractive, particularly for global investors deciding between the more expensive sovereign bonds in Europe and Japan. We encourage investors to maintain diversified strategies within their bond portfolios, emphasizing exposure to intermediate-term, high-quality bonds and investment-grade corporate bonds.
Earnings growth is the key to our stock market forecast. The good news is that a combination of better economic growth and potentially lower corporate tax rates could lead to double-digit earnings growth in 2018. Our expectations for valuations to hold relatively steady, together with our earnings projection, support our stock market forecast of 8 to 10%. And of course, we always keep an eye on risk. If Congress fails to pass a tax agreement, or if a central bank makes a policy mistake, it could impact our forecast. But if strong business fundamentals and tax reform come through as we expect, 2018 has the potential to see positive double-digit returns.
In the stock market, we believe the return of the business cycle will be evident in both profit growth and active management. After holding essentially flat from 2014 through 2016, earnings for companies in the S&P 500 climbed approximately 10% in 2017, and we look for a similar increase in the coming year. Corporate profits have historically served as a leading indicator for employment and business investment, which we believe are keys to sustaining the expansion. We look for market growth to be consistent with profit growth as dividends contribute to total return in 2018. Given our profit forecast, this suggests a year-end target range of 2725 to 2750 for the S&P 500 index. In this environment, we recommend that equity investors slightly favor small caps over large caps, value over growth, and emerging markets over developed markets. Our favorite sectors include financials, industrials, and technology. Now, risks to our forecast include geopolitical threats, failure of Congress to enact fiscal legislation, a potential policy mistake by a global central bank, and political uncertainty around the U.S. midterm elections. Though the market's PE remains slightly higher than historical averages, we prefer to view multiples relative to interest rates and inflation, which remain well below historical averages.
The idea of returning back to something can conjure mixed emotions and questions. Is it a reluctant return? You know, where you have to just accept that things are back to the way they used to be? Or is it a triumphant return, where we can come back better than ever, armed with lessons learned and motivated for the future? We believe the return to the business cycle has the potential to be the latter, and that investors should not only accept this new environment, but embrace it.